What's good, YouTube? It's your boy Noel here, and then back again with another video, guys. Today, guys, I'm going to be teaching you guys something very, very important, and that is supply and demand strategy. I'm going to be teaching you one of the best strategies out there when it comes to trading, and that's supply and demand strategy. I'm going to be teaching you the most basic way to trade it and the most simplest way. All you just need is stay consistent with it and just rinse and repeat. So let's get on with the chat really. All right, guys. So first of all, what is supply and demand, right? Let me explain this first. What supply and demand? So supply and demand levels are key levels, right? They are key levels in the market. Why are they called key levels? This is because when price gets to those levels, they react in a certain way, right? So I'm going to use my pencil to draw it here. So supply and demand levels are key levels in the market. And whenever price comes into this level or gets in contact with these levels, price reacts to that zone, right? So what we are going to be doing and how we're going to be using a supply and demand strategy or a supply and demand zone, how we're going to be using it is by joining price or following price. We're not going to try to control the market or manipulate the market because we can't even do any of that. What we're going to be doing is allow price to move. We follow price movement and then act when price reacts to a certain zone. I hope you understand what I mean. So now, for example, let's say we have this zone here. Let's say there's a zone here, and this is a key level, right? Key levels can be support and resistance. It could be supply and demand. But then if this is a key level, whenever price taps into levels like this, it reacts. Now, it won't react at that level every single time, but most of the times, if you get good key levels, for retail, they call some of these levels support and resistance levels. But what I'm going to be teaching you today is not support and resistance, it's supply and what demand. So now, how can we spot supply and demand zones in the market and how can we use it? So first of all, how can we spot it? How you can spot it is by looking for impulsive moves. Impulsive moves. You need impulsive moves. And what are impulsive moves? Impulsive moves are moves that have volume, right? Impulsive moves are moves that have what? Volume. Moves that have volume, that are impulsive, right? I'm going to show you on the chart now, and I'm going to show you two different moves so you can understand. So now, look at this. Look at this. Now, this is a bullish move to the upside, right? This is a bullish move to the upside. Now, can you just look at this with your eyes by yourself? Can you compare this move here, right? See this move. Can you compare this move here to this move? Is this not also a bullish move? Of course, it is also a bullish move. This is a bullish candle. These two candles, they are bullish candles. These blue candles, right? This is a bullish move, and this is also a bullish move. But can you compare this bullish move to this bullish move? No. This is also a bullish move, but this other one, it has more volume. It has more what? More volume, more impulse. This move moved with power. It moved with strong momentum. And as you can see, the candles, the volume is really, really huge, right? So when you're trying to spot supply and demand zones, you have to go for those zones that have good impulsive moves, right? You have to look for the zones that have good impulsive moves. So let's see another example. Now look at this area here. You can see the candles. Now, how do you spot those candles with volumes? With your eyes, you can clearly see that this candle, this one here, and this one here, they are not the same. This one has more volume, while this one has lesser volume, right? How do you know that this candle is more fuller than this other one, right? You can see the difference between the two candles. So for you to spot a good impulsive move, it does not have to always be one candle, but when you see multiple, let's say, for example, bearish, when you see multiple bearish candles with volume, that is a sign of an impulsive move, or that is an impulsive move. Do you understand? So for bullish, like in this case, when you see multiple bullish candles, like strong candles like this, you can see these candles forming to the upside impulsively. That's a good what? Bullish impulsive move. See another case here. You can see this market going to the upside. You can see multiple blue candles, multiple bullish candles forming to the upside. Now, this impulse, you can see this impulse here to the upside. This is the impulsive move, and this is what differentiates this move from this move. The impulse, the volume, the momentum. So what does this really show, and why are we actually using this to take buys or sells or to trade? Why are we actually using this? Why are we actually using these supply and demand zones? This is because we believe that the market is made up of supply and demand, buyers and what? Sellers, or sellers and buyers, right? And what they usually do is the market will only respect where there is small liquidity. It only moves in respective of liquidity, right? Where there is money, that's where the market moves towards. It goes to hunt, always going to hunt, right? So now, if the market is moving impulsively in this direction, what that simply means is there is a lot of money in this direction. And what is money? Money is liquidity. So if the market is moving impulsively in this direction, it means there is a lot of liquidity and a lot of volume and a lot of buyers are buying in this direction. Now, when the market is moving to the downward direction or selling from this direction, it means there is a lot of sellers in this position. There is a lot of people selling, there's a lot of volume, and there's a lot of momentum. Just the candles are showing you that sellers are huge in this market at this time. So how do you take advantage of this? You look for the impulsive moves to signify that there is volume at that point, there is momentum, and there's a lot of buyers or sellers. Like in this case, there's a lot of sellers in the market, so that you can trade from those zones. Now, how do you trade from those zones, and why do you trade from those zones? This is because we believe that if an impulsive move can come out from this zone, there's a possibility that when price comes back into that zone, they are going to try to sell again. The same thing happens with the buy. If there's an impulsive buy move from this zone, we believe that if price comes into that zone, they are going to try to buy again. Why are they trying to buy from there? Because that is zone. That's where the price is low. In the market, just like your goods and commodities in real life, there are some goods that let's say you're buying this particular thing, and before you know, the price keeps going high. It gets a very high price, and then it starts dropping back again because a lot of people can't even afford it at that point. But when it comes to the low price, a lot of people start buying. Even the business people, the entrepreneurs, they buy it and hold it. So when the price goes up, they sell it. In real life, this is what happens. So now, even in the market, it's the same. So whenever price moves impulsively with volume to the upside, for example, this case now, it moves impulsively with volume to the upside. That is a sign that buyers, in this case, buyers, in some cases like this sellers, because it's a sell-seller. But in this case, this is a sign that buyers are in the market at that point, that they are buying a lot and they are putting a lot of money and they are moving the market, they are pushing the market to the upside. So when we know that buyers have stepped in by seeing an impulsive move, what do? We should also see that we should also see that zone where price bought from as a demand zone. We should also see the zone where price bought from as a demand zone. Why are we also seeing it as a demand zone? Because we believe if price can go up impulsively from this area, it means that demand zone is a discounted area, is where the price is low. That's why they bought a lot of orders. That's why they placed a lot of orders at that point. So what does this mean? This means if price comes back into that zone, we are going to buy. Do you understand? So since this zone is a demand zone, and we've seen that, okay, this zone is a discounted area. Why is it a discounted area? The last time price was at that zone, it moved up impulsively. A lot of buyers stepped in. A lot of people started buying from that zone. They put a lot of money. There was momentum and there was volume in the candles. So this means that area is a good area to buy from. The price is lesser there. The price is at discount there. That's why a lot of people bought from that zone. So we wait. When price comes back into that demand zone, we buy from there. And in the case of supply, we do the same thing. So I'm going to show you some examples so you can see. So for example, now, this is a huge impulsive move. How do you spot those zones first? First of all, find the impulsive move, right? So this is a huge impulsive move to the upside. That's a sign that a lot of buyers stepped into the market at this point. At this particular time, a lot of buyers stepped into the market. So what do? You mark that area out. You mark it out. Now, why are you marking it out? You see that price moved impulsively from that particular area, right? So what do? You mark that area out. And where do you start the marking from? Another thing that is very, very important is you start it from the opposite bias. Let's say, for example, if this was moving bullish, start marking the zone from the red candle you see there. Now, if you go into more advanced learning, like in my mentorship, I explain more. I talk about things like order blocks, so premium and discounted prices, and all that stuff. Like this is actually deep. Like it's deeper than this. There's a lot more to learn if you go into like a mentorship program and stuff like that. But I'm explaining the most basic way. That's why I didn't even call these zones other block zones. I didn't even call this an other block. So it can just be really, really basic for anybody that is just new to it. Do you understand? That's why I'm explaining it in this way, right? So now this zone, the last red candle before this move, which is like the opposite bias of this move, is where you start marking your zone from. In this case, where it is a sell or sell momentum to the downside, or where there's sell candles to the downside, start marking your zone from the last candle that is an opposite bias. When I say opposite bias, I mean if this is a bearish candle and this is selling impulsively to the downside, you know this is bearish. Where you should start marking your zone from is from this blue candle, where the opposite is starting from. This is bullish, and this is where it stops before this impulsive move to the downside. So you start marking from the last candle of the opposite bias. Do you understand? So now in this case, since we saw this impulsive move to the upside, and we see that price bought from here, which means it's a good demand zone, what we do is we mark it, but we start marking it from what? From the opposite bias, which is this sell, right? So we start marking from this sell candle, and we extend it to the right-hand side. Always extend to the right-hand side when you mark it. So what is our plan? Our plan is that whenever price pulls back into the zone, we buy, right? And you can see this is the impulsive move to the upside, and we wait. We mark out the zone, extend it to the right-hand side, and we place our what? Risk to reward position. Put your stop loss, and you can target at least 1 to 2. If you want to target 1 to 1, that's good for you. You can target 1 to 1. 1 to 1 is not a negative risk to reward. Anything below 1 to 1, like 0 point something, is a negative risk to reward. But once it's 1 to 1, that's not negative. It's still a good risk to reward. 1 to 2, good risk to reward. 1 to 3, good risk to reward. 1 to 4, anyone, right? But make sure you start from 1 to 1, nothing below 1 to 1. Go from 1 to 1 upwards. You can go for 1 to 1, 1 to 2, or 1 to 3, but not below 1 to 1. So let's go for 1 to 2 in this case. So let's say we are using 1 to 2, and we're going to be staying consistent with what? 1 to 2 risks to reward. So now see what the market did. After this impulsive move to the upside, we marked out that zone, and price started dancing back into the zone. It did a lot of stuff, but you just be patient. When you're trading supply and demand, you have to be patient, right? And all of a sudden, it's not even all of a sudden, because this on the 1 hour time frame, if you count the candles, it took a lot of time for price to get here, right? So price just kept moving, and it ended up coming into the zone. Now this is where we buy from, and we let the market run. So I'm going to show you another example real quick. Now, see here, we see this impulsive move to what? To the downside. You can see these candles, multiple bearish candles with volumes coming down, right? So when you see this, where is that zone where all these things start coming from? That's where you mark out and start marking it. Don't start marking it from that particular candle that is the impulsive move. Like these red candles. Now, this is the impulsive move. The other, this is the impulsive move, and this is the bearish candle with volume. Don't start marking from there. Start marking from the opposite bias. If there is bearish candles for the impulsive move, look for the opposite bias, which is like the blue candle, the bullish candle before that bearish move to the downside. So this is where we start marking our zone from. See? Now this is where you start marking the zone from. So you mark the zone, and you extend it to the right-hand side. Always extend it to the right-hand side, and you wait for price to come into that zone. You target your 1 to 2. Remember, we're focusing on 1 to 2 risk reward. Now, price kept going down, and the moment it came into the zone, this is where we enter our trade. Now, there are two things you can do. You can either place a sell limit or buy limit, or place an instant execution for both the buy or the sells. So in this case, you can place a buy limit order here, or you can wait for price to tap into the zone before you buy. In this case, so you can do the same thing. So we're targeting a 1 to 2 risk to reward ratio. Now you can see price taps into the zone. The moment it taps into the zone, it closes this candle and starts selling down with one full candle. It smashed our TP. Now that's another example. So I'm going to give you another example here too. But let me use, since we got buy, sells, let me look for another buy just to match it up. Okay. Now see, you can see an impulsive move to the upside. Look at this. You can see multiple blue candles to the upside. This candle here has volume, and then we have these ones, and then this one too, right? So this is a sign that the buyer stepped into this market, right? So what do? You start marking from the opposite buyers, which is this red candle, from this red candle. And you can see when you mark it out, you set your buy limit order and you wait. You're going to be very, very patient. If price comes into that zone, you buy. If it does not come into the zone, wait. Now, target what? We are targeting 1 to 2 for this setup and strategy. 1 to 2. Price smashed our TP. You can see when it tapped in, it flew up, smashed our 1 to 2 TP. And now we're going to be doing the last example before we end this class. All right. So now you can see good impulsive move happening here. Can you see it? This is clearly good impulsive move coming from here. Price is just selling impulsively to the downside. You can see this here, the move ended. So price has just been selling impulsively to the downside. So what do you do in this case? You can see it started from here, it pulled back, it went impulsively again, pulled back, drops down impulsively. So what do you do? Well, first of all, where is the impulsive move? This is the impulsive move to the downside. Secondly, mark out the zone. This is the zone. Around here, this is the zone. This is the impulsive move. You mark out the zone starting from the opposite buyer. Since it's bearish, from the buy, from that buy candle, sorry. And then you extend it to your right-hand side. Now look at that. The moment price comes into that zone, you can enter, or you set your sell limit order before price taps into this zone. And then you target a 1 to 2. 1 to 2 risk to reward. Now, the moment price taps into here, you can see that it reacted into that zone. It reacted at that zone because it's a good supply zone, and it started selling, and we target a 1 to 2. Now, if I were to take this kind of trades, there are other confluences that I might look for just to make it a higher probability. But believe me, if you use this strategy, you use this style, and you stay consistent with it, you backtest it over and over again, stay consistent with it, it could make you some money too. Like, for real, it could make you some money. This is just pure supply and demand, right? But if I personally want to take trades like this, I'm going to look for extra confluences, and I will even have to explain more if it's in my inner circle, because this is something you can't finish in one video. If you want to really explain the in-depth, the other blocks and stuff like that, it's going to be a very, very long video. But this is just a simple and basic way to trade supply and demand. So that's it for today, guys. If you're looking for the broker I used to trade, I trade with a broker that pays with the fastest withdrawal, and also they are very, very, they give a very good leverage, because I usually flip accounts. If you know me and you follow me on Instagram, you know that I usually flip accounts. So I need a broker with good leverage. So if that's what you're looking for, the link in description, just click the first link in description to sign up with the broker and just start trading, guys. And also, if you want to join my mentorship for in-depth explanation of supply and demand, other blogs, liquidity, and my personal strategy, which is the noelreysforexacademy liquidity strategy, that's my edge in the market, which I've been using. Check my other videos, including my vlogs. If you want to join my mentorship program to learn this kind of stuff, I'm not forcing you to do that. Just know that it's something that is optional. You just decide that you want to take your trading to the next level, fine. Even if you don't want to join, just smash the like button and subscribe to the channel for more content, vlogs, and other stuff too. But if you want to join, level up your trading, become profitable, the link in the description. See you guys in the next video. Peace out.